What's up, everyone? This is my closing trade alert for Nike, ticker symbol NKE. I opened the trade back on the 8th of January 2021 right here, and I sold the 135 put at $1.50. In hindsight, I honestly don't know why I opened this trade when I did. This is right before I really kind of understood the basics of the Elliott wave. And as you can see here, wave 3 peaked out here, and then for some reason I sold here. If I knew then what I know now, this wave 3 had peaked out and then there was going to be an ABC correction and then go higher, right? Somewhere in this area. And surely I would not have been selling on this day here. Obviously hindsight is 2020, but it seems pretty unlikely that had I known my Elliott wave stuff a month ago that I would not have opened this trade on this day. Anyways, in some ways I'm almost glad it happened like this because this shows you why I have switched to selling puts almost exclusively. In my opinion, the long-term trend of the market is going up, right? I mean, it's not even really my opinion. Like 85 or 90% of the time, the stock market is in a bull market. So if you're a bear where you think the market's going to go down, that's a tough row to hoe, man. I see all these guys on Twitter preaching all their bear theories, and man, they've been saying that since the COVID crash way back in March. It's literally almost a year later, and these guys are still saying that there's going to be another crash or blah, 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 blah. Meanwhile, they missed out on a huge bear run. All that to say, as long as you're trading a legitimate, solid company and nothing crazy's going on, selling puts is one of the safer options plays, in my opinion. Yes, the put is unprotected. I guess if you really want to be safe, you would sell a put spread. So yeah, I guess you got to decide what your risk level is and if you want to sell the naked puts or if you want to sell a vertical put spread. Either way, both of those scenarios are neutral to bullish, or I guess bullish to neutral really, because you want the price to either go up or at least you want it to stay above your put strike, right? So I sold here basically at the peak. I don't know why, again, I really don't know why I sold this back here. Even with my normal technical analysis, I have no idea what I was thinking. It basically immediately sold off and went against me, eventually broke through my put strike, and then right around here was technically my break even. Now I will say, if you're playing it safe, technically when you breach your break-even price, you're right around a threshold usually of when you could cut bait on the trade and just take it as a loss. I think I was down about 500 bucks here, and by the time that I needed to roll this trade here on the 27th of January, I had more or less learned the Elliott wave theory, and this looked really good for it to bounce right here. On top of that, the MACD was starting to weaken, at least. It hadn't crossed over, and then also the RSI had bottomed out pretty much. So I decided the risk was worth it to stick with the trade and roll it to the next month. So that's what I did. I rolled it to the next month for a credit. And then sure enough, I just happened to roll the trade on the lowest day, which actually bodes in my favor. So I rolled it here for a credit, and immediately the price went in my favor. And I debated selling here and probably should have in hindsight, but I kind of wasn't paying attention, whatever. I just hesitated, so I didn't do it. So then I just kind of moved sideways here for the next, 3-4 days. And then today I realized that my rolled position, I was at like 75% of the max profit for that rolled position. So at this point, with 75% of my max profit on the rolled portion of the trade, it didn't make sense to hang on to it any longer, really. You know, I still had like 36 days left in the trade, and I could only make 25% more of the profit, right? Well, that doesn't make sense at all, considering I rolled the trade here on the 27th, and then now today is the 11th of February, so that's roughly 2 weeks, right? Like 14 days, give or take. And I made 75% in 14 days. Why am I gonna wait like 36 days to make another 25%? That doesn't make sense at all. If I really wanted to stick with this trade, it would be way better just to roll this trade again and get a new position and then try to make, 50% of your max profit on that new position. Hopefully that makes sense. I'll walk you through the Tastyworks transactions here in a second. But the overall rundown for the trade, I was in the entire trade starting from back here for 34 days. The percent of max profit that I made for the entire trade was 44.4%. Now remember, that's from starting way back here, right? And then I had to roll it, and then I cashed out here. But when I rolled it here, that's technically a new position. And in this new position, I made 75% of my max profit, where if I combine both of the trades, I only made 44.4%, which that's fine. And now this left me with a return on capital of just 6.2%. That's definitely a little low. And then my profit per contract was $160. One more quick note here before we look at Tastyworks. Now I made $160 here in 34 days, right? When I opened this trade here, I only got $1.50 credit, right? So my 50% target on that was 75 cents or $75, right? Well, I ended up having to roll that out, and then I had to be in the trade for 34 total days. So in essence, I was in this trade twice, right? I was in 2 trades for like 15, 16 days each, right? I guess 17 days. So I was in 2 trades for 17 days each, and I walked away with 44.4%, and that gave me a total of $160, right? Where my initial position, the 100% profit, would be $150, where I took home $160 here, right? So it's basically like I did this trade twice, right? I mean, that's literally what rolling the trade is. You're just doing the trade twice. Because when you roll it, you are actually realizing the loss on that first trade. It's not like you're getting some sort of credit going on there, right? Like you actually take, I think I took like a $500 loss here, and then I opened a new position for more credit, which happened to be the same 135 put, but it was a much more aggressive strike, right? Because it was actually in the money at that point. Where when I opened the initial trade, it was way up here at 147, and I sold the 135. So I was way out of the money at like the 15 delta, where when I sold this one, it was in the money and probably at like the 60 delta. So by taking that much more aggressive strike, you make your money back faster, hopefully is the plan. And then that's why you end up with a larger profit here. And that's essentially equal to 2 trades doing it like this, right? Instead of 1 trade like this. All right, hopefully that all makes sense. If you have questions, let me know. Let's look at the transactions in Tastyworks, so hopefully you can understand the math behind all of this. So when you roll a trade, most people consider that as 1 trade, right? Even though it's technically 2. It's like you're doubling down on your position because you think you're still going to be right. So I opened this initial position here, right? Back on the 8th of January, and I sold that for a credit of $1.50. And then I had to roll it to the next month. I was down, and I had to buy it back for $6.15. And so for that first February expiration, I had a loss of $465. So when you roll a trade, you want to roll for more credit than what you just closed for. And so I closed for $6.15, and I rolled it to the same 135 put for $8.25. So that becomes a credit, right? So plus $8.25. Now ideally, you want to roll for a credit and a better strike. So in this scenario, the perfect world would have been more credit and a lower put. So like 130 put instead of the 135. I couldn't do that this time, so I just rolled with the same 135 put. I collected more credit at 825 than the 615 that I just closed the previous one for, right? So now, all things considered, I'm positive $3.60 or $360. So that means when I buy back to close this last leg, if I buy it back for more than $3.60, I will lose money on the entire transaction, right? So in this case, when I bought it back to close, it was only $2. So then I subtract $2 from that, and I am left with $1.60 or $160 profit per contract. Really, when you roll a trade, it's just like you're keeping track of the trade in like a long-term effect. But the reality is, this is just 2 separate trades that I did back to back, and I essentially doubled down on my position. So another way to look at this is that these 2 were 1 transaction, you open, close, and then these 2 were 1 transaction where you open and close, right? So if we do that, and I take this away, these first 2, this first trade that I did, right? The first cycle of the trade, I lost $4.65 or $465. And then the second part of the trade, or the second cycle of the trade, right? I got a credit $8.25. I bought it back for $2. That leaves me with $6.25. So this second trade left me with a profit of $6.25. But this first trade left me with a loss of $4.65. And that gives me the same $1.60 profit grand total of these two separate trades, which is 4 separate transactions. All right, I think I hashed that out pretty well, like twice over, I guess. If you have any questions, honestly, just go back and watch the video. Or obviously you can leave your question in the comment section below. Otherwise, thanks for tuning in, and I will see you in the next video.